the SGH High Conviction portfolio, as the name implies, is a high conviction fund or strategy that seeks to hold up to 25 to 30 of our best ideas. The strategy seeks to exploit market inefficiencies and mispricing through fundamental research and really taking a longer term view. And that's done through focusing on investing in quality companies at a margin of safety. We believe that this is very important, particularly at times like this where there's a lot of macro noise and uncertainty. And it's important to focus back on the fundamentals. And as I say, this strategy really seeks to do that. And we believe that through focusing in the way that we do, that puts the fund very well positioned to grow through the cycle. Over the last 12 months, the High Conviction Fund has returned about 22%, and over the last quarter, about 7.4%. The stocks that contributed strongly to the overall performance in the last quarter have included gold miners in Northern Star and Genesis Minerals. ResMed, the CPAP, global CPAP provider, also contributed strongly, as did Chorus, the NBN or equivalent in New Zealand, the fibre company. The energy sector underperformed during the quarter, and our exposures to Cooper Energy and Beach Energy were a drag on the portfolio. But we think the outlook still remains positive for these stocks over the sort of the medium to longer term. Look, reporting season, I think overall I'd characterise as resilient in a tougher economy. It's clear that the economy is very bifurcated, and the difference between mortgagees and savers is very different, and that's really being reflected in company performance as well. Employment growth remains robust, and that has certainly been underpinning the economy. But we are seeing some evidence in easing in that sort of employment condition. That was certainly highlighted in a number of companies that reported. That said, though, I'd say that there's no obvious signs that companies are aggressively restructuring or looking to cut headcount at this point. But clearly the cost of doing business is remaining very sticky, and companies are really struggling to pass on price increases to customers. In aggregate, earnings through reporting season continued to be downgraded, but valuations continued to push higher. As a consequence, we did see the market continue to perform reasonably well through reporting season. Look, I think reporting season is always an interesting time to get a scorecard on the companies in the portfolio, but there probably were a couple of key areas where we did have changes in views. The first is really around the property sector or REITs. And we certainly came out more constructive out of reporting season around that sector. Property sector is very leveraged, and with interest rates looking like they're having peaked and potentially coming down, that's clearly a positive for interest costs for the property companies. There's also clearly evidence of growing transaction activity. And I think that's also being reflected in cap rates that are becoming more realistic, I think, and that's really supporting asset values and book values more. The last thing I'd say is that on the REITs is that rents are starting to stabilise. And again, we think that that's a positive for the sector. The other area which we sort of became away more constructive on was healthcare. Now, healthcare has really been impacted by COVID, and it's been a very slow and gradual recovery for many stocks. But we did see through reporting season signs of volumes starting to return, particularly in the diagnostic and radiology area, which we're much more constructive on. And also for companies like CSL, which continue to report improvement in plasma collection volumes and activity. I think there's two big pieces of news during the quarter. The first was the Fed's decision to cut interest rates. And arguably that was very well telegraphed by the Fed and really didn't come as a surprise to us or the market. I guess the size of the cut was what was really highly debated. And the 50 basis point cut, I think, signals that the Fed is much more confident around the trajectory of inflation and now has a greater eye in its dual mandate to unemployment. This, in our view, is supportive of that sort of soft landing type scenario, and clearly has been very beneficial for the cyclical stocks that are tied to lower rates. The other piece of major news, I think, was the China decision to stimulate or ease rates. And clearly this has been very positive for sentiment, but there remains a real question in our mind as to the degree which it manifests in a recovery in growth. We still believe China faces a number of structural issues around its property and market and around the confidence of consumers and households, which we think will probably continue to weigh on the economy. We've done a number of things to the portfolio in the last quarter. In July, we started adding to our property and REIT positions, and we continue to increase exposure to those through reporting season on the basis of the trends that I talked about earlier. That has really been funded from interest rate sensitive stocks that are more leveraged to rising rates. So we've sold out of QBE and we've sold out of Computershare. We've also added to resource positions, primarily in BHP and Capstone Copper, which is a pure play copper company. The other thing we've done is we've added to small caps, really on the basis that we see a big valuation differential between the broader market and some of the small caps. A couple of companies we've added in particular include Botanix, which is a pharmaceutical company which has just recently gained FDA approval for a product in the hyperhidrosis market, so that's in the severe sweating. The other company which we've added is Generation Developments. This is a financial services company which sells bonds and has also recently acquired the balance of Lonsec, which is the research and ratings agency, which provides a very strong annuity income.